with your company, what type of loans do you guys offer?
Basically everything. So we've got your traditional like FHA, USDA, VA conventional loans, and then we also have a whole specialty department that has just niche products for investors. So we've got products that don't rely on any income verification for investors to buy homes, like a DSCR loan. I've worked with a ton of self-employed borrowers too. So like we've got 12-month bank statement loans, 24-month bank statement loans. So these will essentially allow people that write off a ton of their taxes to still be able to purchase a home.
Homes. Right.
So it's just creative ways to get people into homes. But the most popular ones that we use are going to be like your traditional loans, the bank statement, home equity lines of credit, which is for someone that already owns a home. It's basically like a credit card on your house. And then the DSCR, which is going to be for the investors. We use those a ton. It's a really simple process. As long as the mortgage payment is at or less than whatever the market rent is, they'll let you close.
Yeah, that's pretty good. That's pretty good.
Yeah.
So that's a lot of loans. Let's break some of these down. So your USDA loan, what would you use a USDA loan for?
Yeah, USDA is really kind of a niche program. You're going to need a 620 credit score. It's more for rural areas. So kind of out in the country. I do find them. It's just a map that the USDA has. So sometimes you will see stuff that is in a community. Like I've had a townhouse qualify for a USDA loan before. It just really depends on where the property line is going to fall. They do have a lot stricter debt to income requirements on it. So your purchase price might be a little lower if you're going to use a USDA as opposed to an FHA, but they do allow for a 0% down payment.
Gotcha.
So you don't have to come out of pocket for down payment.
That's
you will
good.
have closing costs. So that's the only thing.
Now your closing cost is what? Is it still like what 1% or something?
Yeah, generally, I mean, North Carolina standard, you're probably looking somewhere around $4,000 to $5,000 total between closing cost, prepaids, origination fees, like all in somewhere around there. Title work for the attorney and everything too. So
yeah. Now I know we do a lot of business, and we have quite a bit of clients who have a FHA loan.
Yes.
Let's talk a little bit about those requirements with meets the FHA. And the misconceptions of an FHA.
Yeah, the FHA honestly is probably the best loan for like a first-time home buyer. They are a lot more lenient on credit, a lot more lenient on income well, not really income requirements, but I guess the best way to put it is debt to income. So you can have a higher debt to income limit, so your purchase price could be a little bit higher in an FHA as opposed to using like a conventional or a USDA. They do require that you put 3.5% down as a down payment on it. But there are programs out there too that can help you if you need funds for this. So it's a great option for first-time buyers is the best way to put it. I would say anyone that's probably sub 680 credit is FHA loan is going to be your best option to get into a home.
Correct. Now, so I heard you say programs that help you put down your down payment. Is that something that you find for them, or is that something that they do? Because I spoke to quite a bit of people, and they say, well, yeah, I took a home buyer program class, and I'm just like, that's nice that you did that, but it's not necessarily needed at this very moment, because I think everything changes based on county,
they do
sometimes state-wise as well. But
yeah, those are weird. The down payment assistance programs, I mean, there's multiple options out there. The ones that we use, we'll actually find them for you. So we have North Carolina Housing Finance Agency. There's another one within Charlotte called House Charlotte. And then there's another one if you're looking in South Carolina, that's South Carolina Housing as well. But they'll all give you, North Carolina has got two programs. It'll give you 3% or $15,000 to use for down payment and closing costs. And then the House Charlotte one is specific to Charlotte city limits and Mecklenburg County, but they'll actually give you anywhere from $10,000 to $30,000.
Wow!
And you can combine those two as well, so you could potentially get up to $45,000 in down payment assistance.
Wow!
It's not free money.
Yeah, it comes with stipulations.
It has stipulations.
Yeah.
So the biggest thing I tell everyone is if you have your own funds, I probably would not advise using this, just because we all know rates are high right now. They have a 7-year recapture period. So basically what that means is 7 years, you have to keep this loan that you can't refinance it.
Right.
If you refinance it, they're going to want their $15,000 back.
Wow. So, now is that like it's an immediate lien, correct?
Yeah, it's a second lien that's attached to your property. So what that means is you're going to have the primary, the first mortgage, which is just going to be your monthly payment. The second one's going to be for whatever that down payment assistance amount is. And there's going to be no payment required on it. It's a 0% interest rate. It's deferred for 15 years, which means it's just stuck in that second position with no payment. If you end up keeping the house for 15 years, they will fully forgive the $15,000. If you sell it before year 15, depending on what year you sell it, you might owe a percentage of it back. You might owe the full percentage back.
Wow. So have you ever seen that before?
I've seen it where people have refinanced before the end of the year 7. Generally, it's like I've been able to just pay the $15K lien off out of the equity in their house when they do it. I haven't actually had anybody have to come out of pocket and like pay for it. But
there's ways around it.
There's ways. If you have enough equity in your house, you can just pay the $15K out of your equity and just get rid of the second. It's situational though. I mean, you're gonna have to look at it and say like, hey, how much am I saving? Is it worth it to give this $15K up to save $100 a month? Probably not. But if you're saving $500 or $600 a month, I mean, it's probably at that point it's probably worth it.
Correct.
So it just comes down to the client and the situation.
Yeah. Now up to date with your FHA, have you ever ran across any stipulations that prevent an FHA like going? Because you have all these little paint chips in the grass, and in my mind I'm like, all right, go ahead and go over there, go ahead and cover up, rake it. I think he went over there when it was dry and he blowed it. Right. And so I think he came back out. He didn't come back out immediately. He came back out like 2 or 3 days. So now I'm having to call the other agent and say, hey, listen, they're going to come out on this day. So we give it a rest. They come back out and it's like, nah, it's not happening.
They got it done though.
Yeah. I tell you, and when I finally got back, because we eventually pushed it out like a week or so. So we were still within deadline time. But I came back and I even tried myself.
Really?
It was like, dude,
yeah,
they're
bad.
This stuff is in the mud.
Yeah.
And what made it bad was there was like pebbles or rocks. So
and it was in the gravel.
Right.
Because I remember calling the appraiser and I was like, what do you want us to do pick all the gravel pieces up?
Yeah,
like,
yeah.
We can't do that.
Right. So it was a tough one, man, but that was a fun experience.
Yeah, it was. That's the biggest thing that I see is the paint chipping, honestly. That's the number one. And those are usually the only time you're going to see like a delay in your closing is like something that's completely outside of our control.
So I know you work with a broad market of people. A lot of people are in transition from different states.
Yeah.
What is some of the best advice you could give from people who's coming from state to state in regards to their loans?
That is a big one. The biggest thing is when you're moving from one state to another is really just going to be the income piece. So if I have a client right now, for instance, that's relocating from New York to South Carolina. She doesn't have a job lined up. She's trying to figure out where she qualifies. And I was like, hey, I can't really give you a pre-approval letter until I have an offer letter or if I have a remote work letter from your job. If you work fully remote, it's fine.
It's fine, right.
Fine, really easy. But the main thing is you really need to have a job lined up so that way we know how much you're going to be making because we're not going to qualify you based on your income in the current state you're living in.
So from my understanding, she's moving to buy a house.
She's selling a house up there and she's purchasing one down here, but she has no job lined up yet. So I was the easiest way I usually do it is I'm like, hey, how much do you make now? Yes. And then I'll look at that and then I'm like, have you started looking at jobs down there? And if they tell me yes, I'm like, okay, was the pay pretty comparable to what you're making now or is it going to be less? Granted, this lady's moving from New York, so it's less.
It's a lot less.
Yeah, so she's like, I'm going to be making somewhere around 60. So I'm like, okay, based on 60, if you were to get a job for this is where you would qualify, just so I can kind of give her an idea of like where she can start looking. But the main thing is like I would never put anybody under contract until they have that because that can all change. I mean, you could tell me you're making $60,000 and then you get a job and you're making 55 and say we might have really needed that $5,000.
Man, it's a big killer.
It is.
It's a big killer. Now, would you advise her to reinvest some of her profits to help that debt to income ratio?
Yeah, that's what she's wanting to do. So she's going to take, I think she's only taken out $100,000 loan amount. So it's
Okay.
a pretty small loan amount for her. So
Yes.
she's basically taking all of her profit from the house up there and she's going to put it down on this house down here just to kind of keep her payment pretty low. But some people, I had someone right now that made like 80K and he just took the 80K and put it in his bank and put the minimum down on the other property.
Nice.
So
Smart.
it really just depends on your situation, I
Yeah,
guess.
yeah. So it's very important to have a job at least lined up.
Yeah.
If you're gonna go across state to state.
At least start looking, have an idea of what you're going to pay, or have a job lined up. The easiest way is remote work letter or new job with a salary. If we have a salary offer letter, we can just take a salary offer letter. We never need to see pay stubs or anything, and we can close your loan.
Right.
If it's an hourly position, that's where it gets a little trickier. We're generally going to need to see pay stubs before
Yes.
you can close.
Yes. Now I know there's quite a bit of people with this 401k.
Oh yeah.
And I've experienced it a little bit, but from your experience, how would you advise someone who wants to use money out of their retirement to make their first initial purchase?
I don't see it as a bad option, honestly. I mean, they'll let you pull from your 401k penalty free to buy a home. It's an investment. Honestly, if you look at how much your 401k is going to appreciate versus what a home appreciates, is probably
It's probably a no-brainer. Yeah, it's a no-brainer. It's a no-brainer.
But I mean, they'll let you use it. I've had clients use it in the past where they pulled from it. Another big one with 401ks is sometimes we just need cash reserves in your file just to strengthen the file. So I'll ask just if you have a 401k just so I can put it in there to make the file stronger. You generally won't have to use it sometimes unless you want to, but
Yeah.
it just strengthens your file, makes it a stronger loan is the best way to put it when you have more assets in there after you close.
Right.
But they do allow you to pull from it penalty free. You would need to call whoever has your 401k and just ask them about the terms of withdrawal. But if you tell them, hey, I want to buy a house, I want to use my 401k, what do I need to do? They'll generally tell you all the steps that you have to go through. And then from there, you can kind of get an idea of, I think you might have to put it back within a certain time frame. I'm not 100% sure. I would talk to them, but they're all different.
Yeah,
but they don't penalize you if you pull from it for a 401k.
So is that
for
with
closing costs or down payment?
So is that with a traditional IRA and a Roth IRA? Because the
Yes, I
taxes are
don't think it would work with an IRA, just because that's like because of the tax benefit on it. You have to wait, and then I probably wouldn't pull from an IRA anyways because they split and double. But that's just my own thinking.
Yeah.
But I mean, you could always pull from it.
Yeah, it's probably not wise.
Yeah, because I mean, IRAs split and double every so many years. If you start pulling out of that, you're going to lose your compounding interest in it. So,
Well, I've had investors.
Really?
Investors would use some of their Roth IRA.
They probably have something the same as the 401k where it's like, hey, you can pull it as long as you put it back within this time frame. Yeah. Like I know they actually do, because I've had a client do that in the past. They gave him a certain time frame where he had to put the cash back in there. So he pulled it out and then put it back. It was just a flip. So it was an investor same way.
Right.
Yeah.
Right. Just borrowing against yourself.
Yeah, just borrowing against himself basically.
Right.
It's always a good option.
Right. Now, in those list of loans, I also heard you talk about the DSCR loan.
Yes.
What exactly is that loan?
So that's a debt service coverage ratio is what it's called.
Okay.
So essentially, it's just a loan for investment properties. You can't use it on a primary residence or a secondary. What it is they'll allow you to come in and purchase a home based on the property's cash flow. So we don't, like traditional mortgages, we're going to qualify the client. We're going to look at your income, your credit score, all that. All we're going to do with the DSCR is make sure that your credit is, I mean, we can go pretty low with these depending on investor experience. I would say rule of thumb, probably 640 plus credit score.
Okay.
As long as you have 640 plus, if you're a first time investor and 20% down, that's all that they're going to require for you to close on this loan, as long as the monthly payment on the rent schedule comes in. So what we're going to do is, with these, how we're going to determine the income is an appraiser is going to go out to the property and they're going to complete a rent schedule, which is like a form 10007. That's then going to tell us how much the market rent in the area is for this property.
Correct.
And then that's what they're going to determine the income as is going to be the rental.
Yes.
So as long as the easy numbers, let's say it rents for $1,000 and the payment's $999, they'll let you close on it.
Wow.
Even if it's $1 over. As long as it's like at or over, they'll let you close with 20% down. They actually will let you buy it too if it comes in less. They'll just require that you put 35% down. So
wow.
You
just gotta have a little money in the bank.
just gotta have a little more money.
have a little money in the bank.
I mean, they'll do it. They're investment loans. So the best way to put it is the investors come in and they measure their risk, and then they determine if they will lend on it or not.
Right.
So they're really specific on the actual property and the where was I going? Really specific on the actual property and the client. That's the two things they look at: investment experience and the actual property.
Now, how long does it typically take to close that type of loan? Because it's an investment loan, and there's a lot of risk management involved with that. So there's a lot of decision making.
Those generally take longer.
Okay.
We don't necessarily do those in-house, is the best way to put it. Most of our other ones, like conventional, FHA, USDA, all those are done in-house. We close them in 21 days or sooner. Anything that's going to be these niche specialty products, we're then dealing with it in-house, plus we're dealing with another company. So it usually takes us anywhere from 45 to 60 days on those.
Wow.
So it's a little longer close on them, just because it does have to go through 2 to 3 different hands. And like I said, these are not traditional loans. They don't have traditional guidelines. Yeah. So one thing comes up, and then they could request 6 additional documents from you. So, I mean, a lot of it really, too, comes down to how fast the client gets us everything we need.
Gotcha.
If we're waiting a week on documents, we just lost a week
Worth of time.
Yeah.
So